Good afternoon. Welcome to Fasken's 16th Annual Global Mining Group Seminar Series. My name is Frank Mariage, and I am part of the Fasken Global Mining Group. I am also a partner in Fasken's Montreal office. Today's event, Project Blue Critical Materials Forum 2026, is the 12th and final session in our series of seminars. I saw that, Andrea. Seminars of this year. For those watching online, as this is a hybrid event, there's a link to our seminar series beside the video window. And for those in the room, information on our registration desk. Anyway, there's got to be a little typo. That's okay. As you view the info on the slide of the screen, I'd like to provide land acknowledgement. First Nations, Inuit, and Métis have been present in Canada for thousands of years. These Indigenous peoples have a profound and ongoing attachment to this territory. At Fasken, we recognize that we have a role to play in the ongoing process of reconciliation between Indigenous and non-Indigenous communities here and elsewhere in Canada. We have embarked on the reconciliation journey by adopting a plan with the overall purpose of contributing meaningfully to reconciliation. Let's begin. I would now like to introduce my friend and partner, Tom Eldridge, a partner from our London office, who will introduce today's speakers. Tom, enjoy, everybody.
Thank you, Frank. Good afternoon, everybody. As Frank said, I'm Tom Eldridge. I'm one of the partners from the Fasken London office. And I'm delighted to introduce the Project Blue team to you today. I don't know how many of you were here last year for the presentation or have seen any Project Blue material or presentations before, but you're in for a treat. We've certainly left the one of the best ones to last. So I'm just going to introduce them in the order in which they're going to speak. Firstly, on my immediate right, Johnny Nee. Johnny's a senior analyst with Project Blue, and he leads global modeling and market intelligence for nickel, cobalt, scandium, and also work on the vanadium flow battery sector. His background includes directing offshore wind supply chain projects across Asia Pac with Tecmar Energy, and in his spare time he earned himself an MBA with a focus on energy transition. So his insights, as you'll see today, help Project Blue's forecasts and analysis across multiple emerging markets. Next up is Luc Geer. He's a research manager. He's specializing in the downstream demands across the key energy transition markets. He brings deep expertise in electric vehicles and energy storage, having led research and consultancy projects for both multinationals and emerging startups. Before joining Project Blue, Luc held senior analytical roles at Benchmark Minerals Intelligence, as another intelligence company that you might have heard of, and IDK Tech X, focusing on battery demand, cell production, and EV technologies. Lastly, at the end, Dominic just flew in just yesterday. Dominic Wells, he's the research director with Project Blue, and he's leading the firm's global costs and ESG analysis and shapes its commodity cost services. Dominic has extensive experience delivering bespoke cost intelligence and benchmarking across hundreds of operations worldwide. He's a frequent speaker on cost and ESG trends. Dominic was previously led the smelting and the refining cost research at Wood Mackenzie and covered battery metals as a senior analyst at Roskill. So, without any further ado, I'm going to introduce Johnny to start. We've got three sort of separate presentations that are all quite different in content. So what we'll try and do in terms of questions is we'll stop after each individual presentation and just have a short period for any questions that people have got before we move on to the next one. There will be time for questions at the end of all three presentations, and then we will be having a drink and some refreshments afterwards, so you can always catch them then. So no further ado, I'm going to hand over to Johnny.
Thank you so much, Tom. And good afternoon. My name is Linghui, and it's not spaghetti linguine. So, and my family name is Ni, and also the element like I spend most of my time researching. So today, my discussing will be nickel and cobalt, and focus on the concentration of the supply chain of upstream and how demand evolving in the lithium-ion battery of these two elements. So lithium-ion batteries can be divided by cathode chemistry. Today, there are two main families. First, LFP and LMFP. These are iron-based chemistries. They do not contain nickel and cobalt. Second, NCM and NCA. These chemistries could contain nickel and cobalt. Since 2024, LFP and LMFP have been leading the market. The main reason are its lower cost advantage. My colleague will explain in detail later. And also, of course, the better safety compared with NCM. This shift was mainly driven by the technology progress of LFP material in China. Since 2024, LFP start to dominate the mass EV market in the country and replace low nickel NCM materials in the market. In 2023, LFP and LMFP represented about 33% of the global battery market. By 2025, this increased to 67%. Looking forward, the share is expected to decline slightly to around 59% by 2035. As a result, nickel and cobalt containing cathodes lost market share from 65% in 2023 to about 32% in 2025. By 2035, their share is expected to stabilize at around 34%. However, lower market share does not mean lower demand. From 2025 to 2035, demand for nickel and cobalt-based cathodes is still expected to grow at around 13% per year. This reason is simple. High nickel cathodes provide higher energy density. They are still essential for premium and long-range electric vehicles, and for performance-focused applications like robot. In China, around 81% of EV battery installation right now uses LFP. However, Western markets are still mainly use NCM and SCA. It is also important to note that China controls much of the high energy density LFP technology and also material export of LFP. Because of this, Western EV markets are expected to remain structurally dependent on nickel and cobalt chemistries over the next decade. Within this segment, high nickel materials such as NCM 811 are expected to grow the fastest, with a CAGR of around 20% between 2025 and 2035. This growth could accelerate further after 2030 when solid-state batteries begin commercialization. So let's look at the nickel and cobalt demand in lithium-ion battery sector. Starting with nickel, in 2020, batteries represented only 7% of total nickel demand. So nickel is mainly used in stainless steel. By 2035, this is expected to rise to around 27%. Between 2025 and 2035, nickel demand from batteries is projected to grow at around 10% per year. For cobalt, growth is much slower, around 3% of CAGR during the same period, because cobalt intensity per battery will decline as the market moves to a high nickel cathode material. However, batteries remain the dominant end use for cobalt, accounting for around 71% of total cobalt demand over the next decade. So, even the cobalt intensity per battery is falling, total battery-driven cobalt demand remains structurally significant. Now, here is the key issue. Nickel and cobalt supply is not well diversified. Nickel mining is heavily concentrated in Indonesia. Copper mining is concentrated in the DRC. And processing capacity for battery materials is highly concentrated in China. So here we look at the whole NCM-NCA battery supply chain. Starting with upstream, Indonesia supplies around 66% of global nickel mine production. The DRC, Democratic Republic of Congo, supplies around 64% of global cobalt mine production. For midstream, China produces over 77% of global nickel sulfate and about 87% of global cobalt sulfate. For PCAM, precursor cathode active material, China produces around 67% of global output. For cathode production, South Korea accounts for 45%, the biggest producer. However, it is heavily reliant on Chinese PCAM supply. China itself accounts for around 37% of global cathode production. Looking at NCM-NCA battery production, China represents 42%, North America 28%, and Europe 21%. So, as you see, the downstream battery manufacturing is more diversified. The upstream and midstream segments remain structurally concentrated. This creates a clear bottleneck risk for Western producers, and since 2025, we have already seen this risk materialize through the direct policy intervention in both Indonesia and the DRC. So here we look at the Indonesia and its nickel policy. So in December 2025, Indonesia announced a 34% reduction in its 2026 mining quota. There's a background, like Indonesia has banned all the nickel ore out export since 2020. So, and it has the RKAB system. So it is the annual mining work plan and budget approval system. Every miners in Indonesia needs to apply for RKAB annually since 2026. It tends to annually just in 2026. Before that, miners only need to apply it every 3 years. The new quota has been set around 260 to 270 million wet tons nickel ore. Actually, it is around 30% decrease year on year. According to our calculations, Indonesia will require around 343 million tons of nickel ore in 2026. So if it imports 20 million tons of nickel ore, and it will have 80 million tons of nickel ore shortfall this year. Historically, Indonesia has revised its quota upward from the low quota it stayed actually beginning of the year, just like in 2025. So the new round quota will be approved in July every year. We expect the final 2026 quota to land somewhere between 300 and 360 million tons nickel ore. So consider different RKAB and nickel ore quota scenarios. Indonesia supply over 65% of global nickel. At 260 million tons RKAB, the global nickel market will directly go to deficit. At 303 to 360 million tons of nickel ore, the market remains oversupplied by roughly 130 to 250,000 tons of nickel. So in 2025, the nickel market has been oversupplied by 212,000 tons of nickel, and it has been oversupplied for many years since Indonesia and China has increasing their supply of nickel. So now looking at longer term, as Indonesia has a downstream nickel policy focusing on EV battery production, we forecast there will be more MHP, nickel sulfate, and the nickel cathode capacity will come online in the country. So the demand for nickel ore in the Indonesia will increase, especially for low-grade nickel ore. We call it limonite ore for battery sector. And if its imports is stable at around 20 million tons per year, Indonesia's domestic oil supply would need to grow at around 4% per year through 2035. This implies a structurally higher nickel ore quota over the long term in order to support its downstream policy. And let's take a look at the DRC and its cobalt policy. So in February 2025, the DRC imposed a complete cobalt export ban to support prices and renegotiate its regulatory framework. The ban lasted for 8 months last year. In October 2025, it was replaced by a strict quota system, which is expected to remain in place at least through 2027. Under this system, exports are capped at 96.6 thousand tons per year in both 2026 and 2027. This is about 56% lower than the 2024 export level. Quota allocations favor major producers. CMOC receives around 32%, Glencore receives around 20%, and ERG receives 11%. From an ownership perspective, China-linked assets account for 42% of total quota allocation. In November 2025, Glencore became the first miner to test this system. However, the first trucks only crossed the border of the DRC in January 2026. Logistically, it takes around 4 months for cobalt hydroxide from the DRC to reach Chinese refineries. This means bulk shipments of cobalt are unlikely to arrive before the late April at the earliest. As a result, this creates near-term feedstock tightness. In 2026, the cobalt market is moving from surplus in 2025 into a tight balance, and by 2027, a market deficit is expected. So finally, due to the policy-driven supply interruptions, short-term price reactions have already been very sharp. LME nickel price rose by around 60% between December and February. Cobalt prices increased by more than 200% following the initial export ban in the DRC. Looking beyond these policy shocks, structural deficits are expected to emerge after 2030. Turning to the nickel sulfate, under current capacity assumptions, a project deficit equivalent to 55% of total nickel demand could emerge by 2035. As a result, nickel sulfate prices are expected to rise by 42% between 2025 and 2035. For cobalt sulfate, a project deficit of around 23% of total cobalt demand is expected by 2035. Cobalt sulfate prices are forecast to increase by about 123% over the same period. These structural tightness trends are mainly driven by high nickel cathode demand, supported by solid-state batteries and technology breakthrough like the humanoid robots and the VTOL, or we can call it flying vehicles. So in conclusion, nickel and cobalt-containing batteries remain critical for premium EVs and high-performance applications. However, supply remains highly concentrated. Indonesia controls nickel ore, the DRC controls cobalt ore, and China dominates processing capacity. The policy intervention in these upstream countries is active and increasing. For resource-rich countries such as Canada, this presents both risk and opportunity. Securing upstream supply and developing midstream processing capacity will be essential. If Western market aim to achieve strategic control over the battery materials such as nickel and cobalt, in an era of resource nationalism and trade fragmentation, nickel and cobalt prices will increasingly reflect not only cost curve, but also political decisions. Thanks so much. Yeah.
Are there any questions for Johnny before we move on?
with the increase in nickel production to try to meet that demand, what do you see as the impact into the scandium markets as that is starting to stand up as well as a byproduct of nickel? You said you cover
So
scandium.
scandium right now actually is, if I can say the asset name, is actually Ramu in Papua New Guinea, like using MHP and sent back to China to produce nickel sulfate and also scandium oxide. And scandium demand actually is mainly focused on FEOC. So the main demand actually in the Western market, especially in the US. So we think, of course, it will make more supply of scandium from nickel. But actually, the key question is how the demand will, change in the next few years. If we see like scandium alloy can be increased, like response to the supply increase, yes, it can increase so quickly. But if we see demand is still so flat, just like last few years, and also China has because scandium is still a part of the rare earth elements, I think. So right now, it's like two bubbles. One is in China, very much supply, but demand is low. And another bubble in the Western market have certain kind of demand, but the supply is Rio Tinto in Canada and Japan, Sumitomo Metal Mining. Yeah. So it's still, the quick question is still like how the demand will go in the next few years to respond to the supply. Yeah. Thank you.
Any other questions for Johnny? Nope, I don't think so. Okay, thank you, Johnny.
Yeah, thank you.
Okay, yeah. Hello, everyone. My name's Luke. I'm going to be talking about some of the trends that we've seen in electric vehicle battery demand, then also a little bit about copper demand as well at the end. But overall, it's been another very strong year for electric vehicles in 2025. So 20.1 million passenger battery electric and plug-in hybrids were sold in 2025. As you can see, the vast majority of that's coming from China, who are approaching about 2/3 of the market share. Europe's in second place there with about a fifth, and then the US is at about 7%. US now in a bit of a decline, which I'll get to on a later slide. But you can see the kind of remarkable progress that particularly China has made over the last 5 years. I think one thing that's easy to forget is that the Chinese EV market was lower than the European market only in 2020, but since then it's grown at a CAGR of nearly 60%, to about 12.5 million in 2025. And it's also reached a monthly penetration rate of 56% as well. So really, really strong EV sales out of China. One caveat with this is that in 2026, we do potentially expect the first decline in the Chinese market. That's really at the moment driven by a loss of some of the policy drivers. So there's a less attractive tax incentive, which started in January of this year. And there's also been a loss of some of the trade-in subsidies for consumers as well. And beyond seasonality, January and February sales have been very, very low in China. So one thing we're waiting on is to see if the government changes any of the policy. So that kind of depends. The 2026 annual outlook kind of depends on that. But at the moment, sales are lower in China. Europe has turned the corner. So you can see 2024 was a very kind of bumpy year for Europe. That's really down to loss of subsidies in key markets. So Germany was a big one, but also just generally tough economic conditions, high interest rates, high inflation. The corner turn in 2025 is due to the next phase of CO2 emission standards that happened. So fleet emissions of CO2 were reduced by about 15%. This is something that's going to become more and more stringent up to 2035 when there's essentially a de facto fossil fuel ban in Europe or in the EU. There have been some concessions on that. So I think Germany lobbied to have a 90% reduction instead of 100%. So there's a 10% window there where alternative fuels could potentially be used instead of pure battery electric. But that kind of faces the same problems that we've seen with fuel cells over the past 5-10 years, where the infrastructure is very costly, hasn't manifested itself. So it's really a case of the infrastructure being available rather than the automakers making the vehicles themselves. So essentially, it's still a kind of a BEV future for Europe. The US is kind of on a declining path now. So we're at a point where it's lost all of its major policy drivers. So we lost the tax credit in September. You can see that there was a bit of a surge in BEV sales between June and September. That is in anticipation of losing the subsidy. So that's kind of really policy driven. But since then, we've seen a big decline, and it's really hybrids now that we expect to win in that market. Mainly because they're more profitable to sell, and the kind of emissions standards now will allow them to be sold for a much longer period of time. And I just wanted to highlight as well some of the bright spots. So the rest of the world, so outside of China, Europe and the US, what I've discussed so far, is actually the fastest growing EV market at the moment. And there are two kind of strategies that are playing out here. You can see on the dotted line there, it very, very strongly correlates with Chinese exports. So this is the kind of the first strategy that countries have. So you've got like Thailand, South America, they're really kind of growing their markets now by importing lots of BYDs and Chinese vehicles. But then the other strategy is local auto manufacturers building up and selling models themselves. And that's happening in Vietnam with VinFast, happening in India with companies like Tata Motors. So yeah, two divergent paths, but I think it is quite clear that Chinese exports are going to play a really important role in electrifying some of these rest of the world markets. And then finally, just a bit of a forecast of the overall electric vehicle sales before we get on to some of the battery demand. So yeah, in 2025, we got about just over 20 million. We see that rising to about 50 million by 2035. Most of that is still going to be coming from China, but over the long term, you can see that China starts to plateau a little bit or saturate as it starts to reach kind of 60, 70, 80% of the market, and the market therefore just naturally starts to slow down, and we'll start to have a pickup in sales, or the growth being driven more by Europe and then some of these other rest of the world markets, as I said. In terms of battery demand, we're at about 2 terawatt hours, or just under 2 terawatt hours of demand in 2025. Again, most of that is coming from China for the reasons I've just discussed. We see that rising or roughly doubling by 2030, and then approaching 9 terawatt hours by 2050. As you can see, automotive is really the kind of driving force behind this new growth in battery demand. It takes up 80 to 90% of the market share through to 2050. But I think an important thing is not to discount some of the other markets, particularly stationary energy storage, which is shown here in light blue. So this is actually the fastest growing battery demand segment at the moment. And we also see that market growing very rapidly throughout the entire forecast period for the next 25 years or so. So still a very important high growth market. And one that has quite a different kind of outlook in terms of chemistry adoption. So I'm showing cathode chemistry adoption here for EVs on the left-hand side, and then stationary energy storage on the right-hand side. So touching a little bit on what Johnny said as well and went into. So we do see LFP at the moment. It's still the dominant chemistry, the cathode chemistry on EV demand. That's really because of China. So China has about 70% market share of LFP in their EV sales. And as we've seen, China has 2/3 of the global market. So that really puts LFP in a strong position. And also most of the exports coming from China are using LFP technologies as well. So that's another growth driver outside of China for LFP. But we do see a bit more technology diversity as we go through to 2035. So in purple there, we've got NCM high nickel. We see that really as being one of the winning chemistries in the Western markets, particularly in Europe, which we're predicting as being higher growth. But I guess the lower cost sensitivity, the higher emphasis on range and premium performance in the European market, we think is going to help drive that chemistry. On the ESS side, so the ESS is not so much driven by performance, it's mainly driven by cost, which is why we just see LFP dominating effectively globally here. But I'd say the one big difference to note is perhaps the emergence of a bit more non-lithium ion in the ESS sector. So you can see that that's the dark navy segment on that chart at the top of the bar chart. And most of that, it says non-lithium ion, most of that is sodium ion, essentially. So we do think over a medium-term period that the cost reduction potential of sodium ion could be comparable to LFP over a longer term. And as I say, because cost is the driving factor of the ESS market, then it has more opportunities there. So this is our market balance for lithium-ion battery supply. You can see broadly that we see the market balancing over the medium term and the longer term through to 2032. And most of this is captured by operational supply already. So the already kind of robust supply chain is meeting most of the demand that we see for the foreseeable future. The deficit starts to emerge when I think it's more to do with losing visibility of projects. There just haven't been many announced projects past 2033. So that's not necessarily to say the market will go into a deficit, but yeah, we do see the market being balanced for the foreseeable future. And then on the right-hand side, you can see the breakdown by region. So really, yes, China is the only one in a big surplus and is going to be having to taking up some of the shortfall in some of the rest of world markets. And yeah, really rest of world markets relying on China for battery supply for the foreseeable future. One caveat there is the US market we do see being in a surplus. That's mainly down to the kind of flurry of investment we saw a few years ago with the IRA. And now, because the demand for the US is much lower because of the weaker policy drivers in that market, that's why we see that the market being in a surplus for the next few years. So also wanted to show our lithium market balance. So this is showing lithium carbonate battery grades and lithium hydroxide battery grade. So again, for the foreseeable future, we do see the broad market being balanced with slight differences between hydroxide and carbonate. So the carbonate supply is a bit tighter because of the higher demands on LFP, with a bit more surplus in hydroxide, which turns into a deficit in the 2030s as we expect more demand from NCM from other markets like Europe, as I discussed. So I'd like to end talking a little bit about copper and copper use in electric vehicles and some of the high demand sectors for copper. So copper is an essential material for almost every aspect of the powertrain of an electric vehicle. You can see the breakdown there. Our estimates of copper in a Model 3 Highland, one of the most popular BEVs sold globally. And most of the copper is found in the battery pack, so current collectors, bus bars. And yeah, that's something that's not going to change. But we do also see a lot of copper used in the motors as well. So this is just modeled off a single motor base model. So that's a permanent motor. The copper is in the stator windings, but in other variants where you have dual motor setups, you also have induction motors that uses copper in the stator and the rotor, so effectively doubling the copper intensity. So there's a lot of potential for copper in electric traction motors and in the powertrain overall. We also have the high voltage cabling, so about 18% of the copper demand from EVs and that high voltage cabling. There is some risk of substitution there for aluminium, and I know that has been happening in some in some cases with Tesla in short stretches of the powertrain. I believe between their plug socket and the onboard charger. But overall, copper is going to be the dominant source there because of the conductivity and the efficiency gains there. But because there's so much copper used in BEVs, we see that being a really strong driver for the overall copper demand in the automotive sector. And you can see how much quicker the growth is in that light blue segment from our demand outlook in the copper sector for automotive. Another high growth sector for copper is solar and wind. So here I'm just showing our overall demand forecasts for solar and wind. On the left-hand side is solar, on the right-hand side is wind. While we see perhaps solar installations plateauing a little bit for the next decade or so, that's really down to bottlenecks on infrastructure, but also supply chain issues. There's a much more, I guess, diverse reliance on different materials in the solar sector, where you're relying on silver solar back paste, polysilicon, copper, aluminium for the frame. So a lot of the price rises are causing difficulties in the solar market at the minute. But on the other hand, we see the wind market really starting to take off as it's driven by just larger and larger capacities of turbine, and then also really strong growth from the offshore market. So this is our copper demand outlook for offshore wind and onshore wind. So we're seeing that market rise from about 600 kilotons in 2025 to about 1,500 in 2036. And what's interesting here is that although the offshore forecast is lower, because it's a less, I guess, less established market, more copper is needed for the offshore market to interconnect the cables far out sea. So when you do translate that back to copper demand, the differences between the two aren't quite so stark. I also wanted to highlight data centers as well. So I think AI is quite a new area that's just beginning to tap the start of its potential. So this is all going to need connecting with copper cables and copper interconnections. Although we're predicting very strong growth in 2026, about 40% year on year, we're having a bit more of a steady state outlook through to 2036, but this could easily be a much more aggressive outlook depending on how the AI story progresses. And yeah, finally, just showing overall copper demand. So we're looking at rising from about 35 megatons of copper in 2025 through to just under 50 in 2036, with a lot of that growth being driven by these high demand sectors that I've just spoken about. So yeah, that's where I want to end on the demand side. Happy to take any questions now or in the panel afterwards. But yeah, thank you.
Do we have any questions for Luke? I don't think so. Oh, we've got one over here.
What are your thoughts on the substitution of lithium by other minerals?
So I think the big one's probably sodium ion, I guess. So I think that particularly in the EV market, it's really limited, and the main reason for that is just you're always chasing a moving target in terms of cost. So the development cycles in the automotive market are 5 years. We haven't yet seen a sodium ion battery, for example, enter that market, or even other. I mean, they're still using lithium, but other novel technologies like solid state or lithium metal. By the time those are actually matured in the automotive market, you're looking at a cost that's 5 years away instead of comparing with the cost now. So I think just the cost competitiveness of chemistries like LFP make it very difficult for substitutions like sodium ion to enter into that market, particularly automotive where performance is also required. I think there's more room, as I say, on the ESS side, where you don't have that kind of performance need, and you do have a bit more of a just battle between the costs. But I don't really see anything other than sodium ion in the non-lithium space really gaining a lot of share. So,
Luke, are you worried, or should we be worried about the sort of well-publicized forecast supply deficit of copper in this context? With the lack of exploration work and big projects coming on, we could, in a future world, we could solve the processing problems and the midstream problems, but then simply have not have enough supply on the copper side.
I think, that it's a valid concern. I think that in the EV side, there are areas of substitution. So you can technically go without copper in the motors. You could technically go without it in the high voltage cabling. I think it'd be very difficult to substitute it in the battery, though, which, as I showed, is the most important source. I think there are areas where we could tweak things, but overall, it still need a lot of copper to support these emerging markets.
One more question over there.
I think since we are at PDAC and there's a lot of talk about exploration, what I don't see is any phosphate exploration projects to really provide supply to the purified phosphoric acid market. And I think that's something which is, in my opinion, completely overlooked. Everybody's looking at copper and lithium and also on, but would be nice to hear your view, because this purified phosphoric acid market is so tight. And I don't see any projects out there which can make the Western world kind of independent on that side. So it would be nice to hear your view on the phosphate discussion.
I can't speak to that too much, but I don't know if anyone else on the team can.
Actually, I do apologise. I'm going to follow Luke's example here. I wouldn't want to give an example on the phosphate market without one of the phosphate analysts going for it, but definitely something to follow up on. Yeah.
It was actually related to phosphate, but the LFP chemistry. So you mentioned that you see more demand, an uptick in demand for nickel-based chemistries beyond a certain time frame from the EU market. Mm-hmm. What do you see for LFP demand from the North American market in the long term? Given that, we had the IRA and those policies previously in place that, with the FEOCs and that focus on nickel-based chemistry, not on material from China, which is the big LFP producer. Just curious.
I think it will be limited, to be honest. I think the key thing with America is that it won't be importing much. So most of the LFP is coming from or produced in China. So I think that kind of limits its adoption on the market. But I also think that we're starting to see a shift towards hybrids as well in the US. So I think the preference there would also be nickel-based chemistries. So I think there will be some uptake of LFP in the North American market, but it won't be that significant. And all the share that is gained there will be supplied locally by some of the local projects in North America.
Okay. Thank you, Luke.
Thank you.
Jolly good. Thanks, Luke, and thanks Fasken again for hosting such a brilliant event. Didn't realise that I was going to be the last one speaking, actually, so it's quite nice to be headlining. I don't know if I want to say that. Well, hi there, everyone. My name's Dominic Wells. I'm a research director here at Project Blue. My focus has always been on the cost and ESG side, as Tom said. What I'm going to be doing today is doing a bit of a sort of eclectic presentation. I'm going to be speaking about first the cathode active material and lithium-ion battery sectors, going through the main cost drivers of the industry, seeing how our commodity price forecasts that we've been speaking about here today are going to impact the cost of producing CAM and lithium-ion battery packs. And then I'm going to sort of pivot because CAM and battery costs are often a bit of a dry subject. So I'm going to give an update on the rare earth market as well, just to sort of finish strong, I suppose. Excellent. So looking first, forgot I had two screens there. So looking first at the cathode active material sector. So what does the cathode active material industry look like in 2026? What are we seeing today, based on what both my colleagues Johnny, Linghui, and Luke have been speaking about? So in 2026, what we can clearly see by looking at the cost curve is a very clear bifurcation of the CAM sector, cathode active material industry, between lower cost lithium iron phosphate and LFP chemistries on the left here in light blue, against higher cost nickel cobalt manganese chemistries on the right there in orange. Now, even on a US dollar per kilowatt hour basis, as this curve is, what you get is that the improvement in energy density in NCM does not really overcome the difference in NCM production costs in the first place. Indeed, LFP chemistries have actually made really quite significant cost improvements in recent years. And in terms of energy density, and this has really allowed LFP to dominate and outcompete the NCM CAM chemistries as well. So LFP and LMFP production dominates the lower half of the cost curve, with improvements again in their energy densities. But this coupled really mostly with low lithium prices in 2025 and sort of previously as well. And the fact that LFP manufacturing capacity is often centered in large-scale semi-integrated plants in China as well, which then have favorable lithium price agreements, lower input costs such as labor, reagents, and consumables, etc. And we're going to look in more detail on this in a moment. And again, this has really contributed to their lower cost positions on that curve. And then in comparison, you have the higher raw material costs of NCM chemistries, means that these producers occupy the higher end of the cost curve. And this is even despite things like low nickel prices in recent years. This has really not helped NCM producers from being on the higher end of that cost curve. And then as well as higher raw material costs that we're going to be looking at in a moment, NCM producers also suffer from higher input costs at these facilities. This includes things like labor, G&A, particle coating, and research and development compared to LFP producers. But that's not entirely all of the story, as we're going to see in this presentation. So examining cost breakdowns now in a bit more detail. In this graph, what we're seeing is the weighted average cost of producing cathode active materials broken down by cost components in 2026, and again broken out by the different kinds of CAM chemistry as well. So you can see here how raw materials in blue and green here, in blue and green shades, are the dominant CAM production cost component, regardless of what CAM chemistry you're producing. A facility's cost performance is essentially based on its raw material consumption and offtake agreement price, and this is the big caveat that goes along with any cathode active material or lithium-ion battery cost analysis. So in NCM chemistries, you have nickel, cobalt, and lithium are the largest cost contributors. You can see here in dark blue, light blue, and light green. And very notably, if anybody can even make it out, you've got manganese being an almost negligible cost element in the current market. It makes almost no impact on overall CAM costs, with the exception being on the left-hand side there, LMO and LMFP chemistries a little bit. LFP production costs are almost entirely dependent on lithium costs. It's really their driving cost factor. And again, just to emphasize again, right, with lithium prices having been at recent lows in 2025, with the exception at the end of it, this has further sort of driven down costs and made them far more cost effective and given credence to what my colleagues were talking about. There's, of course, a bit of a caveat to all of these numbers as well. You've got the fact that in many cases, CAM producers, depending on who you are integrated with sort of raw material producers upstream in the market, meaning that high cost of production may not be realized due to more favorable pricing systems, more favorable offtake agreements, or even integrated systems as well. And again, all of this analysis is currently through the lens of relatively historically low lithium and nickel prices, again, with the exception of the end of this year. So the question then becomes, given how sort of unsustainable something like the 2025 lithium price was, how much are these operation costs going to change over the next decade as we see prices recover? So based on the price forecast that we have going over in the next 10 years or so, how are CAM raw material costs going to change in the next decade? So first of all, looking at lithium, carbonate and hydroxide on the top there in blue and light blue. So despite recent lows in lithium chemical prices, the market really saw a price spike at the end of 2025, and that's continued into 2026. And this was due to supply disruptions and strong purchasing by traders and consumers ahead of the Lunar New Year in China. And then this is going to be amplified by greater demand growth from cathode manufacturers going forward. And lithium carbonate is forecast to remain the premium chemical over lithium hydroxide on the back of LFP demand. Now, we expect lithium prices to remain elevated throughout 2026 as mineral supply remains tight, which is going to cause tight spodumene prices to be passed up to lithium compound prices going forward. But in 2027 there, you can see a bit of a dip as prices are expected to weaken as supply from mineral producers alleviates the supply-demand balance. This is going to be short-lived, though, as we can see here. We're going to see continued strong demand growth outpace the development of new lithium supply between 2028 and 2030, which is then going to exert further upward pressure on lithium compound prices for both carbonate and hydroxide. And we've already sort of spoken about this briefly, but in the case of nickel, the story is similar, though a little bit delayed. Over the next sort of 4 years or so, you're going to see nickel sulfate prices remain suppressed on the back of oversupply from Indonesia. But by the early 2030s, the market is going to see more and more tightness, and that's going to drive prices for not just nickel sulfate, but all nickel compounds upwards. Into the 2030s, we're forecasting a growing market deficit in the nickel sulfate sector as demand for NCM outpaces supply, and the industry is going to require additional investment in nickel sulfate processing capacity. And this is inevitably going to come at a higher cost and will drive higher prices as well. And then finally, focusing on cobalt sulfate here. So given the Congolese government, the DRC's cobalt hydroxide ban and then subsequent quota system that came in at the end of 2025, along with a lot of market uncertainty, cobalt prices increased rather sharply. And for a short period, converters actually began dissolving cobalt metal into cobalt sulfate to meet very near-term battery demand, but the cost effectiveness of this has largely ceased and the practice has largely ended. And then as feedstock supply continues to tighten, cobalt prices increased accordingly, and from going forward, Project Blue expects cobalt sulfate prices to remain pretty elevated from their pre-2026 levels for the next decade. So, looking at a really sort of short-term outlook here, so how have the recent changes in commodity prices impacted cathode active material production costs? Now, depending on how spot prices in early 2026 impact CAM costs, we could see significant increases in some CAM production costs against others. And what you have here is the cost of producing different cathode active materials based on 2025 versus January 2026 spot prices, just as sort of an academic exercise to see what the theoretical sort of cost exposure is to the raw material sector. As I say, we could see significant increases in some CAM production cost against others, but it's really worth noting that these cost estimates are based on CAM production costs being impacted by spot prices only. Again, it's sort of purely academic, and it doesn't account for things like long-term contract prices or long-term offtake agreements and integrated structures, which are obviously designed to insulate your downstream sector from spot price fluctuations, such as the one that we've seen in January 2026. And in January 2026, what we saw was lithium carbonate prices peaking at over $20,000 a ton on the spot price from a 2025 average of just $10,000 a ton. And then simultaneously, over the same period of sort of 2025 average to January 2026, we saw nickel sulfate prices hit over $4,100 a ton, up from $3,300, and cobalt sulfate prices doubled from sort of $7,600 to $13,800. So again, similar process to lithium there. Now, with all of those caveats and under these very specific conditions, both LFP and NCM CAM costs could increase really quite notably. You see that on the right-hand chart here. LFP costs, have seen increases of sort of over 60%, depending on sort of which asset you're talking about and which chemistry. And NCM chemistries tend to average production cost increases of, typically sort of around 50 or even a bit less than 50 or something like that. And of course, while LFP and LMFP costs tend to increase slightly more than NCM, the fact that LFP already started at a sort of lower cost base means that they still retain their lower cost base in the first place. So even under all the raw material price changes that we've seen in recent months, LFP still continues to outcompete NCM on the cost curve. So now looking a bit further long term, right? Looking over the next 10 years. So with long-term raw material prices rising, this translates to a corresponding rise in cathode active material production costs, as anybody one might expect. I don't think this is a particular epiphany to anybody here. And I've highlighted here NCM 811, LFP, and LMFP, and I've compared their Chinese production costs versus ex-China rest of world production costs as well. So NCM 811 costs are expected to increase by approximately 30% over the coming decade in real 2026 terms. And this is driven by the rise primarily actually in nickel sulfate prices, but also by cobalt sulfate prices and lithium as well. And LFP and LMFP costs are also going to see significant increases, but notably less so than NCM 811, as they have no exposure to obviously to nickel sulfate, and the majority of this price increase is actually going to come from lithium prices moving. But of course, again, to caveat it right, given that they're starting from a lower cost base, it means that these chemistries are going to retain their lowest industry cost positions. And even there, you can see sort of a slight decrease in 2027 as lithium prices react to a bit of an oversupply from the mineral sector as well, and that pushes prices down for LFP and LMFP. And as we can see from these graphs, right, Chinese production shown in the dashed lines is going to continue to be marginally lower than ex-China equivalents. There is a huge discrepancy and disparity between where you are building your cathode active material plant and where you're producing it. Not every rest of world country outside of China has a ubiquitous sort of cost equivalent. And the difference really comes down to things like economies of scale from larger scale facilities in China, more favorable raw material contracts, lower direct cash costs such as labor, reagents and consumables and fuel, etc. But it's of course, again, very difficult to say what the effect of integration and long-term contract agreements are actually going to have on cost performance. And we're looking at CAM costs through the lens of spot and contract price changes on different chemistries. So I've sort of got three presentations in this bit. So this is the conclusion to the first. So don't worry, I'm afraid you're still here for a little bit longer. But just to sort of draw a conclusion on what I've just been speaking about here, right? So LFP is the lowest cost method of cathode active material production, and it's going to continue to be for the next decade. And that's what's really driving LFP demand over the next 10 years. And this is driven by lower raw material consumption rates, lower prices, and lower direct cash costs really centered in China. Raw material costs are the dominant cost component of producing CAM, cathode active material, with lithium, cobalt and nickel costs making up roughly half of total cathode active material production costs, depending on who you are and sort of what you're producing. And on top of that, raw material prices for these battery materials are forecast to grow over the coming decade, right? And this is driven by battery demand, governmental intervention, as we saw in the DRC, and increases in production costs generally outside of raw material production costs. And then even already in 2026, right, we've seen these really quite notable increases in cathode active materials costs, especially in LFP and LMFP that have risen, theoretically by sort of 60% based on the raw material consumption. And that's driven by lithium price recovering. And finally, in the longer term, we forecast cathode active material costs to grow as raw material prices force costs upwards, and especially in places like NCM 811 due to higher nickel sulfate prices as Indonesian oversupply is eroded. So now looking further downstream now, just taking one further step and looking at the exact same cost analysis, but looking instead now at the lithium-ion battery sector and seeing how the changes in cathode active material prices is going to impact the cost of producing cells. So you'd probably be forgiven for thinking that I'm just showing you the exact same cost curve. They are very, very similar, but what does the lithium-ion battery cost curve look like in 2026? So again, just to kind of basically reiterate my first sentence there, right? Today, the industry is very bifurcated. I've emphasized it there with this nice red line. Very clear distinction between high-cost NCM and lower-cost LFP cell production. Almost exactly the same as what you see in CAM costs as well. There's a number of reasons for this. I'm sure you can probably guess what they are mostly, but the cliff notes of them, we're going to go through them a bit more in the presentation, but the cliff notes are that while the majority of batteries are produced in China today, and actually slightly greater proportion of LFP are produced in China than NCM, and LFP being and China being a lower cost jurisdiction means that you end up with a sort of lower, it brings down the cost of LFP overall. China's really gone sort of full steam ahead on LFP manufacturing. Chinese facilities are lower cost than Western counterparts, almost to a T, with lower labor costs, energy costs, reagents, etc., in addition to sort of lower raw material costs as well. And they're also typically larger scale. That brings down their overall costs as economies of scale kick in as well. And also, as we've seen when looking at cathode costs, LFP is singularly exposed to lithium prices as opposed to NCM, which is exposed to lithium, cobalt, and nickel and manganese. And with lithium prices, again, sort of being caveated here, being at sort of historic lows, pulling through from 2025 in recent years, the effect is LFP outcompeting NCM on the cost curve, which typically have higher cathode active, with NCM typically having cathode active material costs double that of LFP when you're producing a battery. But it is worth noting, of course, that the difference between LFP and NCM costs here is actually reduced. So there is some cost saving coming on board when you go further downstream when you're looking at the NCM market. So a bit of a deeper dive now into comparing lithium-ion battery chemistry costs, and specifically LFP versus NCM, but focusing first on the left-hand side there on LFP. So when you look at this sunburst chart, I believe it's called, on the right here, the sort of pseudo pie chart, you can see here that on the right in dark blue and light blue, the significant exposure to cathode and anode costs at LFP producers in 2026, right? Within this, cathode costs in dark blue there are the largest cost component, but again, also partly the effect of sort of low lithium prices at LFP manufacturers. And then within cathode active material costs for LFP, you have things like lithium carbonate, iron sulfate, ammonia, hydrogen peroxide, and then of course things like electricity, fuel, labor costs, and the like as well. The other cathode costs in this case are things like binders, aluminium, and conductive additive material. Now, we can see here that while costs are similar across both in terms of exposure, LFP batteries are actually marginally more exposed, interestingly, to anode costs in light blue there. They make up both a higher cost proportion in terms of overall total costs, but also they are a higher dollar per kilowatt hour basis cost as well. And sort of within anode costs, you have things like copper and anode, and sort of copper anode and anode active material in there as well. And it also same goes for the other consumable costs such as separators, electrolytes, and cell casing. But this is all sort of for the birds, right? Overall, this graph kind of shows exactly how LFP is maintaining this lower cost position and its low cathode active material costs. As I say, half cathode active material costs when you're looking at the battery side compared to NCM. And now doing the exact same thing, but moving now over to focusing on NCM costs. Now, there's one really obvious similarity with LFP, but the difference is really stark. NCM is significantly more exposed to cathode active material, and therefore raw material prices such as lithium hydroxide, nickel sulfate, cobalt sulfate, manganese sulfate. Now, the obvious difference between the two, or might not even be quite so obvious on first glance, is that the next largest cost component of NCM producers is not anode costs, as it is with LFP. It's actually other direct cash costs, which is a sort of suitably vague cost element here. But this essentially is things like G&A and R&D and labor, etc. The labor intensity of NCM is actually far more significant than it is at LFP. The NCM manufacturing process is more complicated than LFP. It's got more raw materials, more moving parts, and the result is a higher G&A, higher R&D, higher sustaining capital cost, etc. So a sort of quick look now at costs of lithium-ion batteries by chemistries and countries. The graph on the left here really kind of just confirms what we sort of originally knew. Low-cost LFP is just dominating the industry, with NCM chemistries making up the higher end of the cost curve. Even, as you can see here at NCM 622 producers, this low-cost bar is actually the result of large-scale Chinese producers, which are keeping cathode active material costs as low as possible, as NCM 622 has the sort of cheapest cathode prices. And then here on the right, we see a sort of confirmation of the trend of China dominating. You've got other Asian countries such as Japan and South Korea, which are also outcompeting Western countries, but these countries also typically focus on NCM chemistries over LFP. They focus on the higher premium chemistries as well. And then on the higher end of the chart, we have German and US battery manufacturers. Obviously, this isn't all the battery manufacturers in the world. The US is generally considered the sort of highest cost, though it does depend on which asset you're talking about. There's significant discrepancy in an awful lot of this. As we sort of looked at in the previous one on NCM, you'll remember that one of the largest cost elements of NCM production is labor. And the US has some of the highest labor rates in the world, and hence why their costs are pushed up. Again, huge discrepancy depending on the asset you're talking about, and there is a lot of variation there. So now looking at historic and future trends in battery production costs, I always do like this phrase that they're called lithium-ion batteries for a reason, and this graph really sort of emphasizes exactly why that is. Can clearly see how both NCM and LFP production costs saw massive spikes in 2022 on the back of high lithium prices, which then pushed cathode active material prices upwards, pushed up lithium-ion battery costs as well, though of course the industry was nowhere near as developed as it is today. And this was then followed by this rather, dramatic cost drop as lithium prices dropped through 2023 and 2024. And what's really interesting is that since 2025, both chemistries have seen a price spike, but NCM's price spike is actually significantly, is considerably more notable. Now, while both of them saw increases in lithium prices, obviously, this disproportionate effect on NCM costs is actually due to the rise in cobalt sulfate prices as the Congolese government introduced the new quota system, and we sort of spoke about that previously. Now, looking forward, you can see there that we see costs for both increasing quite steadily from next year onwards. As I mentioned in the previous section, lithium prices are going to rise steadily on the back of greater demand, as well as tighter, higher cost supply. And then lithium carbonate is going to remain that premium chemical, which is going to put a little bit of pressure on LFP battery manufacturing production costs, but not enough to really knock it off any kind of significant basis. And then for NCM, nickel prices are going to remain depressed for the next 4 years, but then by the late 2030s, we see sulfate prices ticking up as Indonesian oversupply is really eaten away. And for cobalt, after the initial shock, prices are going to actually remain relatively subdued, being driven largely by aerospace demand and minor demand from the MCM sector as well. So again, just to sort of conclude this section, right? So the low cost LFP cathode active material production translates very, very clearly and very directly to lower cost LFP cell production in 2026. I don't think that's a particularly incredible conclusion to draw. But again, this is due to lower lithium prices, but the cost saving is mitigated ever so slightly by higher anode costs at LFP producers. And then the second point to make here is that the CAM costs are the dominant cost component of cell costs overall. NCM CAM costs are actually double that of LFP, hence why their costs are so large. But then other large items include things like labor rates during the manufacturing process and, of course, anode costs as well. LFP batteries are the lowest cost on the curve, but you've got high nickel chemistries offering the best cost competition, with NCM 622 and 811 offering the most cost competition with LFP due to their low raw material prices and rather large manufacturing scale in China. And while all raw material prices impact battery costs, lithium really has been the dominant driver in recent years, with its very fluctuating price and a sort of unsteady and unstable price going forward historically. Both LFP and NCM are largely dependent on lithium prices for overall costs, but you really saw a price spike in 2022 causing those OPEX spikes, and hence their disproportionate impact. So I'm going to now pivot almost completely and give an update on the rare earth industry, looking at sort of how we see investment in recent years having been drawn into the rare earth sector, and how at the rest of world ex-China capacity can really make can really sort of drive its own investment, and also how the industry is going to develop going forward. So looking first at how Western governments have begun ramping up their funding of rare earth projects around the world. So what this map shows here is government funding for rare earth projects since 2021. Bit of a marking here, right? The bubble relates to the scale of the investment, and those with outlines are more recent, if you were sort of curious about the key there. Highlights really are that Australian and North American projects have been the most funded, and the big ones are things like MP Materials, Linus, and then most recently you've got operations such as USA Rare Earths, Vulcan, and ReElement Technologies. Now, a key point here, of course, is that the United States is leading an awful lot of this investment. In fact, it's the main driver by a country mile. And we look at that pie chart, which hopefully you can see on the bottom there. Another really key trend emerges, right? The vast majority of investment in the rare earth industry from government funding is going towards multi-stage projects. So, for example, these are going from mining to refining, or they're going from mixed rare earth carbonate to metallization. They need to have at least 2 stages. That is where the majority of this investment is going. And you see their sort of separation is taking an awful lot of this investment. So an MREC to a separated rare earth product, a metallization product. That downstream side, the 11% is actually magnet production only, and it's a sort of exception that proves the rule in many ways, right? It's that 11% is basically Vulcan in its entirety. So the projects that have the most success in getting funded in the rare earth industry are those that are targeting multiple stages of the supply chain. So the point here is that and then the second point to make, is that investment has been ramping up pretty rapidly since 2023. You can see that from the bar chart on the bottom. And previous years' large funding has actually been the result of a single large investment, as opposed to any sort of concentrated group of funding packages made by any government. And again, similar to what I just said, right? The exception that proves the rule, right? You have a Luca in 2022, that's that large investment. Arafura in 2024, again, exceptions that prove the rule. They are single large investment packages, as opposed to a single concentrated funding package across the industry. Now, since 2025, you can see in dark blue there that the United States has already flooded the industry with funding. 2026 alone has already beaten, and 2026 alone has already beaten the previous years as well. And this all comes from just USA Rare Earths and Serra Verde in Brazil. So the main point here is that the rare earth industry continues to need public support in order to develop in the West if the West wants to develop its own mine to refined rare earth supply chains. So looking now at the neodymium magnet production capacity forecast that we have. So these graphs state what capacity has been announced at projects looking to develop NdFeB magnets outside of China. So looking at that left-hand one, right? So the capacity ex-China that we have is around 35 kilotons currently of NdFeB magnet capacity, but it's going to expand to over 100 kilotons by 2030, based on only on currently announced capacity. And a large amount of that magnet capacity in the pipeline is directly to diversify away from China, and it's being fed into the automotive, defense, and energy sectors. You can see here a little bit that you've got sort of Estonian and Indian production ramping up towards the end of the decade. But the main highlight is that the United States, which accounts for a significant proportion of, is the United States, which accounts for a significant portion of ex-China capacity. And to reiterate as well, right, this is only announced project capacity. It doesn't make caveats for things like expansions at existing operations that haven't yet been announced. You could easily see a situation in which a jurisdiction like Japan, which already produces a fair amount in 2025 and 2026, expanding its capacity as well. Just announced ones at the moment. Now that right-hand chart, so this is looking at NdPr, neodymium, praseodymium requirements of NdFeB capacity. So currently supply exceeds demand expectations outside of China, right? But by 2028, when you look at that graph on the left and you compare it to the graph on the right, a lot of this new United States-based NdFeB magnet capacity begins being commissioned, and that's going to push demand for neodymium and praseodymium metals higher and higher. That dark blue line, by the way, just shows the needed ex-China NdFeB magnet demand based on the graph on the left there. So what this shows is that if the capacity on the left is built, we will still need around sort of 70 to 80 kilotons of rare earth oxide mined at additional new projects outside of China, and this is not including even existing capacity based on the NdPr content at new mining projects. And in reality, of course, it's probably going to be even more, right? So the market's in significant deficit by the time you sort of get to 2028 based on announced NdFeB magnet capacity announcements. So we've touched on sort of NdPr, but what about heavy rare earths, right? So there's two charts on the left here. They're a little bit sort of difficult to read necessarily, but they essentially show here that overall there was a 60 to 80% reduction in export volumes of terbium, dysprosium, lutetium, and yttrium compounds from China in 2025 as very strict export controls took effect. And the right-hand chart shows that despite export volumes decreasing, demand has continued to grow outside of China. And this has created a squeeze for heavy rare earth elements, which is why we then see premiums for heavy rare earth material because of these restrictions. But of course, the issue is that outside of China, there's not enough people really producing them. And this graph sort of shows why, right? So well, it's not a graph necessarily, but what this shows is the separation of rare earth compounds and how the bottleneck in heavy rare earths materializes in the industry outside of China. So in green there, you have sort of most projects shows that they're taking MREC and they're producing a lanthanum, cerium, NdPr compounds, Seg, samarium, europium, and gadolinium, and heavy rare earth mixed products. But the point is they're not going too far into the heavy rare earth sector, and they're not producing metals necessarily. They're producing intermediate products. Some projects there in yellow are targeting separated metals, but almost none of them, in red here, are targeting low-cost, non-high growth, niche rare earth element metals. This is things like gadolinium and holmium and europium, etc. These volumes are too low. It means scaling revenue is sort of next to impossible, and this then restricts capital investment. And along with, on top of all of that, you're sort of outcompeted by China on a cost point of view anyway. So on top of that, if new sources of these elements were to come online, it would then put downward price pressure on them, sort of effectively killing markets and sort of disincentivizing capital investment in the first place. And then, of course, there's, sort of a little suitable feedstocks. Most, as we see in this graph, most projects are targeting light rare earths, lanthanum, cerium, neodymium, and praseodymium, with very little content in things like SEG and heavy rare earth metals. And of course, the final point, the sort of final nail in the coffin here, right, is that the technical expertise and experience is at a sort of massive premium. There's not enough people that can do it outside of China. There's no dearth of expertise, so you'll be outcompeted by China. And even if you wanted to, the expertise is not quite so prevalent in the industry. There are, of course, a few examples sort of scheduled for producing heavy rare earth elements here. But essentially, we sort of read through this chart together, but what this essentially shows, right, is that the financials for NdPr and terbium dysprosium are going to be the value drivers for rare earth projects outside of China going forward. And then these revenues are then going to be needed to support the other heavy rare earths, so things like samarium, gadolinium, yttrium, and lutetium. You look at companies like sort of Linus, which is hoping to produce europium, holmium, and erbium in sort of consideration after sort of 2027. MP Materials is sort of looking at others from 2028 onwards. Energy Fuels, similar kind of story, and then Carister is sort of looking at yttrium end of 2028 and end 2028, and others from 2029 onwards. And then USA Rare Earths is sort of end of 2029 or so, when it's looking at gadolinium, erbium, and a few others as well. And of course, what the point of this is, right, is that all of these need to be looked at on a bespoke basis. So situational decisions made on what to invest in are based on the geopolitical and economic environment of the time, i.e. some commodities may actually find themselves at the front of the queue, but depending on governmental needs. And really, that's the sort of question that needs to be answered. And finally, just so looking at heavy rare earth dependency on China in the West. So sort of a slight silver lining here, right? So for terbium and dysprosium, ex-China capacity can actually meet demand over the next decade. What you've got is a sort of reduction in the intensity of in end use, i.e. you get more and more electric vehicle manufacturers asking themselves, well, if we can guarantee that we don't, our electric vehicle motors won't exceed a certain maximum temperature, which would essentially kill your rare earth magnet, do we really need these high coercivity magnets? And we can start reducing the amount of terbium and dysprosium within them. The problem of ex-China demand is really for yttrium. And this is where the sort of problem really arises, right? So you can see from that graph on the top right there that to meet ex-China yttrium demand, supply is nowhere near where it needs to be going forward. The rest of the world is still going to be reliant on China as a source of yttrium products well into 2030, and this is based on project capacities looking at separating yttrium out of feedstocks. So really the main sort of problem area for the West is actually in yttrium as opposed to any other single sort of heavy rare earth element. And I'll just finish my sort of conclusions just to sort of wrap up there. So again, just to emphasize, right, since 2023, we've seen significant investment in rare earth capacity in the West, largely driven by the United States, and investments in Q1 2026 are really already beating all of 2025 put together. And in terms of announced capacity, you can sort of see why, right? The United States is leading the build out of NdFeB magnet capacity, but by 2028, NdPr feedstock supply is going to be outstripped by demand, with about 70 to 80 kilotons of rare earth oxide additional capacity needed just to meet demand, just to meet magnet capacity. Oh God, I'm so sorry. There we go. So sorry again. But so what you've got here is China's just focusing again on the heavy rare earth sector, right? So you've got China's controls of heavy rare earths, which have seen exports of terbium, dysprosium, lutetium, and yttrium compounds reduced by 60 to 80% in 2025. And the result's been this really significant premium for heavy rare earth elements into 2026 at the end of 2025. And for many heavy rare earth elements and smaller niche rare earths, the economic arguments are really quite difficult to make outside of China, and arguably even within China. You've got your sort of core rare earths like neodymium, praseodymium, dysprosium, and terbium, which are going to need to drive funding for other heavy rare earths like gadolinium, samarium, and yttrium. And finally, the main sort of a problem for the West really is going to continue to be yttrium and Chinese yttrium. It's going to be reliant on Chinese yttrium for the next decade or so. But this is despite the fact that terbium and dysprosium supply outside of China is going to be able to meet demand going forward. Thank you very much. I welcome any questions.
Thank you, Dominic. We got a question here.
Yes, thank you for that. It was very informative. Some of the forecasts go quite far into the future. I'm just wondering if you can speak a little bit about the major assumptions of the forecasts.
Yeah, it would depend entirely on the sort of commodity in question. I mean, maybe just to sort of emphasize how we sort of go about building our price forecast. So we obviously have our cost services, which measure the cost of producing, commodities going into the future. And then we start looking at the macroeconomic environment in which those commodities exist. And then we have our sort of demand models and essentially sort of meet in the middle. It's obviously a massive oversimplification. I mean, Difficult to sort of say which sort of assumptions, but maybe something to have. I'm more than happy to talk about it maybe on a sort of longer form, unless there was a very specific demand question that maybe you had on the sort of what assumption we've made over cobalt sulfate or something. Yeah, no problem.
Couple of questions over there.
Thank you. Quite curious to hear you about the midstream processing across all commodities and how the Chinese lack of transfer of technology and potential transfer of technology influences your forecasts. On the mining side, it's one thing, but then the processing and transfer of processing technologies is a completely different story. So quite curious to hear you both on the lithium and on the rare earth space. Thank you.
Yeah, it's a really good point. So for lithium and rare earths, admittedly, they're very different in how China has sort of has gatekept its sort of technology and its intellectual property. The rare earth industry, they're far more litigious, and we've seen significant legal action be brought against those that sort of that are disclosing technological secrets outside of China. Definitely, lithium, it's a bit less so. But the technology is, I don't necessarily want to say easier because it's also quite complicated, but because of the nature of the ore bodies in which you're operating in, with lithium, you're trying to get one element. With rare earths, you have multiple impurities and multiple rare earths and rare earth oxide compounds, which makes the flow sheets and the solvent extraction plants to process that rare earth products infinitely more complicated, and obviously they become then modularized as well. Your sort of original question about how China has managed to sort of corner the intermediate sector. For rare earth, they've certainly been far more successful, but they're also significantly lower cost. Anyway, there are people who, there are a lot of companies, even though I sort of said there's a dearth of expertise, right? There are an awful lot of individuals and expertise outside of China that can process rare earths, depending on which one you're sort of talking about. The question really becomes, can you do it at cost? And of course, within China, you've then got the downstream sector as well, in addition to the midstream, which takes all that material. So even in the rare earth industry, you've got the ability to produce a mixed rare earth compound and perhaps some lanthanum, cerium, neodymium, praseodymium compounds. The problem is you're still going to be selling that to China in the first place. So the economic arguments almost come first, even before any intellectual property questions need to be answered anyway. With lithium, a bit less so, but of course you've also got the brine industry versus the spodumene mineral capacity as well. The brine industry is dominated by ex-China, South American producers anyway. Yeah. No problem.
Thank you for that presentation. That was wonderful. I just wanted to, maybe we can just clarify a couple of points, probably from your last 2 slides or so. Really the key question for me is it your position that there really isn't fundamentally a supply-demand mismatch for the lighter REEs, and there's potential future pressure on pricing for specific heavy rare earths? Is that my understanding based on your conclusions, or what am I missing there?
Yeah, no, I wouldn't say that there's no supply-demand problem for the lighter rare earths, definitely. I mean, you sort of look at this graph here, right? NdPr capacity outside of China is going to be outstripped pretty quickly, by sort of 2028, based on only announced capacity. So it's not that there's no problem for the light rare earth sector outside of China. It just depends entirely on which end uses you're talking about, and specifically which rare earth compounds you're talking about as well. But certainly for NdPr, this is, you can sort of see from this graph, right? This is going to be a concern for rest of world capacity going forward.
Okay. Thank you.
And your other point, just remind me, sorry.
It was part 2 was on the heavy side of things, but.
Well, I suppose it's really just there to emphasize that yttrium is really where the supply-demand problem is going to come in for non-Chinese producers. And again, the export controls that we saw in 2025 really do emphasize that as well. So terbium and dysprosium, again, because you're reducing the energy, reducing the end-use intensity of those compounds within electric vehicle motors over the next sort of 10 years or so, the intensity of use. And because there is there is a decent amount of ex-China supply of both of those compounds, they're less of a concern. But certainly for yttrium is where you see an awful lot of problems for the West.
Mm-hmm. Anyone else? I've got one at the back.
My question is, which metal overall in conclusion, do you think has the biggest supply gap in a projected next, say, 5 years? And that's not sexy.
It's very subjective. I suppose I actually I would say that maybe not even a metal necessarily, but certainly some of the reagents that we have in the manufacturing processes are probably not being spoken about. You did mention phosphate earlier. I do think it's a really good question. I'm keen to sort of get some more thoughts from you on that later. But I do think that some of the acids that are going to be consumed as part of things like the anode manufacturing process and the cathode manufacturing process, I think some of those are probably something that, to sort of to try and fit my answer in with your question, right? I think those are probably the ones that people aren't being quite alert to. I've emphasized yttrium quite a lot, and everybody talks about lithium, for example, but things like hydrofluoric acid and even sulfuric acid in the industry, right? We saw sulfuric acid prices in Southeast Asia spike at the end of last year, and that caused real problems for MHP producers in Papua New Guinea and sort of Southeast Asia as well. So it's those sort of unsexy reagents might actually be a sort of suitable answer for that.
Dominic, just a quick one from me. In terms of batteries and lithium and cobalt, and given the huge component of the battery cost made up of raw materials, and given the price sensitivity of lithium and cobalt and the effect it's had, and the circumstances in which that price can change, and the absence of any hedging or price protection products in the commercial markets, do you see there being a future where there is a form of floor pricing for those components being provided through government regulation in the same way as, on the same sort of principles as the way governments did it with contracts for differences, etc., in solar, very different industries? But because that is really seems to be that in many ways the holy grail in terms of if you can get a floor price on your supply contracts, then you're going to keep your investors a lot more happy.
I'm not sure I'd necessarily see it as a strong possibility from a governmental point of view, but you do see an awful lot of price floors put in situations where you have significant price fluctuations on a short-term basis in places like the lithium sector, and you get that from private offtake agreements anyway. And I think that's probably a more likely place for that. Yeah.
Good. Are there any more questions before we finish? Oh, we've got one more at the back. And we do have time, obviously, when we're going to have some refreshments afterwards, so there will be time for further questions.
I'll be very quick. Throughout your presentations, I think all three, you did not talk very much about government regulations from any of the countries, very little. And then there were the predictions which, went quite far into the future. Is it the case that you assume that everything goes well for the industries for all of these things through the next years, that there won't be any regulations that kind of hold up anything in any shape or form and that money talks, or do you have a different kind of opinion? Would you like to say something about that?
Yeah, happy to. I mean, no, it's definitely a part of our long-term forecast, and actually to emphasize the question you asked there, just to emphasize that, it is something that we take into consideration. And I think that given the Congolese government's movements towards the end of last year and the cobalt hydroxide ban, that's really shown the impact that the governments can have on raw material prices and raw material markets. Certainly, it's a very rare situation that you get where you have a single government able to exert such strong control over a single commodity as you get in the DRC with cobalt, for example. But another example of that would be Chinese export controls of terbium and dysprosium, for example. So yeah, we definitely take it into account. Very difficult to predict, obviously, but you do end up in your price forecast and your supply demand balance is able to identify areas in which governments may be able to exert very specific control under very even short-term periods. I wouldn't want to speak too much about how the price teams come up with their price forecast in case I overestimate or even underestimate how much detail they go into. Yeah.
Okay, thank you. I think that just leaves it for me to call the session to a close, and that ends the 2026 Fasken annual seminar session. So thank you to our excellent speakers, to Dominic, to Johnny, and to Luke. Please continue the discussions afterwards. We'd love you to come and join us for some drinks and refreshments. And thank you to all of you for being at this session and other sessions. Given this is the last session of the whole program, I think it's pretty good. There's not many empty chairs. So thank you for coming. And then a last thank you to Andrea and her team and all the AV. You wouldn't have seen when Frank introduced this as the last one in the session. Andrea did a little dance that nobody can see. There's a huge amount of work that goes into putting these on. So thank you. So, thank you. Thanks very much.